In today's special Life in the Day of Coronavirus episode, I'm going to be talking with Richard Ormond again, attorney at Buchalter in Los Angeles, and we'll be discussing several terms and concepts that you need to know and understand if you are not only going to survive this downturn, but are going to thrive. Hi, I'm Adam Gower, and today you're going to hear how the coronavirus crisis is similar yet different from the 2008 global financial crisis. We're going to be dusting off some of the terms that Richard and I met discussing during the 2008 downturn: receivership, restructuring, and turnarounds, plus how and why the stress on commercial real estate is going to manifest differently than the last go around in the way that it creates distress. You're going to hear some hints at how you can help commercial real estate borrowers during these times of crisis while putting your own capital to use in some novel investment opportunities. All right? Put another way, this crisis is different because you can help get our country back on the road to recovery while making money doing it. And in today's episode, you're going to learn some of the key mechanisms, some of the key terms that you need to know for how to do exactly that. All right? Now, be sure to go to the podcast page at gowercrowd.com and sign up for my newsletter, where we'll be sharing more information on opportunities as they emerge and how you can contribute to the recovery while making money in the process. You'll also find a host of resources there on the podcast page and at gowercrowd.com: how to upgrade your home office, a guide for crisis communications. It's a huge discount on our flagship investor acquisition system master course. There's a series of podcasts tailored there specifically on how to thrive during this time and not just to survive. All there at gowercrowd.com. Importantly, sign up for my newsletter so you can be one of the first to hear about the opportunities that will likely emerge out of this whole morass. Now, with probably one of the most important conversations you will hear for a while from my friend Professor Richard Ormond Esquire, who is going to share with you the key concepts you need to know as we edge closer to the beginnings of recovery from the current crisis. Here is today's podcast. Richard, thank you for joining me again. It is fabulous to see you.
Likewise. I wish it was in person.
Exactly, that's right. Well, there will come a day when we will be able to do that again, but not for now, while we are still in this crazy time of coronavirus. Certain things you and I have been talking about have been coming across your desk. And you and I, when we met, there were some key terms that were the main terms that were used in the real estate industry that have kind of faded from view, but are coming back with a vengeance. Those three terms are receivership, restructuring, and turnaround. So let's talk about each one of those in order. Let's start with, Richard, what is a receivership? And what's going on now in the market? Actually, we could even start with that.
Let's do both. So a receiver, not to get too technical, is something that's existed in British common law for about 1,000 years now. And it was a mechanism for the court to be able to manage real estate, which was the original intent when there were feuding landlords or feuding landowners that they didn't want the land to lie fallow, so they would appoint an officer of the court to take over that asset until the dispute was resolved. Today, it's most known because lenders use it as a remedy for them to, rather than foreclose on a property, they can get the court to take over the property and operate it for whatever amount of time the court or the bank needs until they're able to foreclose or work out a deal with the borrower or have the receiver actually sell the property. One of the tricks of the trade that we use as attorneys for lenders specifically is that many times lenders don't actually want to foreclose on a property, or they don't want to take possession of that property. Maybe it has environmental issues. Maybe it's a cannabis related property. Maybe it's in a location where the bank doesn't have any reach and it's hard for them just to have oversight. So it's better for them to ask the local court to put an agent or officer over that property and have that agent or officer actually sell it in the open market. There's a couple of other beauties that come with that, is that when a receiver sells property, they get a court order blessing that sale. And so if you're a buyer of that property, getting a court order that has liens move away and attach to proceeds rather than stay on the property, that blesses the court process and all those types, or blesses the sale process. You get even cleaner title than you would normally get, even in a typical sale, because you have
that's right. Yeah, I remember that. That's right. They said they can actually wipe all the liens.
Mm-hmm.
I remember there was one time, as you know, when I was working for the bank during the last downturn. You're quite right. Banks don't like to take ownership if they can avoid it. And we actually took ownership of a hotel for a week. And it's, when you think about it, it's actually a lot of brain damage doing that. You take ownership of, you know, an office building or multifamily, for example, it kind of runs itself. But a hotel, you've got to serve, you know, muffins and change sheets, although today it's a little bit different. You've got to operate the business. I don't mean to interrupt you. Go ahead.
No worries, but hotels have an even additional quirk that if you are a flagged hotel with any type of national chain, which we know they go from the F level chain all the way to the, you know, AAA level chain. Right. If you're a bank, you may not have the manpower or the knowledge or even the resources to put towards meeting the demands of that franchisor. So in a hotel specifically, it is I highly recommend to banks in most instances not to foreclose and take possession of it. But this mechanism is considered by the courts to be a mechanism of last resort. But when you have a major turn in the economy like we did in 2008 and 2009, and now like we have today, that mechanism of last resort becomes much more prevalent. And in just it is now 3, almost 4 weeks into our California lockdown. The last 2 weeks, I don't think I've been on more phone calls in the last 2 weeks than I have in the last 2 years discussing receiverships. Really? And I'm getting calls from 2 different groups. The first group is folks that are now experiencing distress with their borrowers or their co-managers or whomever, asking for advice as to how to put a property or a business into receivership. The other calls, though, are from people that are seeing an opportunity and asking me, what's coming across your desk? What's in distress? What can I pick up for cheaper than I could have picked up 3 weeks ago? So it's an interesting dynamic, and that always seems to happen. There's always someone on the sidelines that has dry powder ready to jump in when the economy turns.
So actually, let's talk about that a little bit later. Let's go through these 3 points. But what I wanted to ask you about receiverships is, so the uptick in the number of receiverships is already significant. I mean, it's happening that quickly.
It's happening that quickly because there's huge anticipation on the parts of lenders that they're already getting contacted by the borrowers that there is going to be a problem. And there are certain types of property types, CMBS, commercial real estate especially, where if your tenant stops paying, you can't afford the mortgage anymore. Now, there are government moratoriums through the CARES Act and everything else that have been put in place for certain types of properties, but it's not a blanket on all types of real estate. Most commercial real estate is going to fall out of that, other than residential related real estate, like multi-tenant, things like that. But a lot of business real estate is right now potentially going to go belly up. So you have lenders
that yes. So yeah. That's, I get that. So, but is there no? Gosh, I'm not really sure how to describe it. But there's these, for no fault of their own, across the entire country, all these entities or these businesses, this type of real estate will inevitably fall into default. And is it that the lenders have no choice? Regulations mandate that they must affect certain processes to recover against those defaulted loans. Is that right? I mean, there's no moratorium on that?
That is absolutely correct. And you're going to have some conflicts because there's going to be interpretations of this new CARES Act that says, well, we shouldn't go after these folks. And the left hand and the right hand are not going to be communicating. And you have very strict regulations post-Great Recession, post-2008, 2009, that say that a bank, once it has a distressed asset, has to take certain steps to eventually move it off of its books.
Right.
So they are going to have a lot of pressure from that side. having them work through these distressed assets, and they're going to have pushback from borrowers with countersuits, class actions, and everything else. I think it's going to be quite a bit of mess, and I don't think the federal government is going to get its act together to provide a lot of clarity. In the end, banks are great lobbyists. Banks are, in essence, when we leverage this economy and when we protect our economy, the first infusion of cash that we give is always to the lenders, because they have the best mechanism to getting money out into the system. So there's a symbiotic relationship between the federal government, the state government, and the banks that they will acquiesce to their needs over time. So there may be a short-term outcry, but the long-term effect will always be that the banks have to work through their bad assets. So while COVID-19 is on the front page of the paper, behind the scenes, you're going to see banks gearing up to figure out exactly what their priority enforcements are going to be, and then what their secondary enforcements are going to be, so on and so forth. One of the interesting things that I've gotten a lot of inquiries about is from bankers asking for referrals to people that understand distressed assets. So they're already anticipating this situation. A lot of the folks that I knew that worked in distressed assets now 10 years ago, 11 years ago in the last downturn, moved out of distressed assets 3 or 4 years later
because there weren't any.
There weren't, right?
Exactly.
And so there is a dearth of experience right now at banks dealing with not just distressed assets, but the quantity of distressed assets that this type of economy can present. Now, let's look at LA, for example, with the moratorium on rents on multifamily. Yeah. Well, there's a moratorium, but those rents still, the way the rules are written, have to be paid back within a year for unpaid rents. So there's a lot of confusion in the marketplace. I think the front page of the LA Times has an article today about it. But at some point, those landlords will have to pay mortgages, and if they don't, those banks are going to have to enforce those loans.
Right. So that's so here. So this is exactly the point. But the issue is the cash crunch that borrowers have. Over indebted borrowers, even on multifamily properties, who are being mandated to defer rent payments, right? So rent payments, but that doesn't solve their cash problem.
Not at all.
Now you've got borrowers potentially unable to pay their mortgages, and banks on the other side mandated to engage in certain processes to rid them from their books for fear of themselves being shut down again, I suppose, if it gets big enough, like it was during 2008, 2009.
No one wants to be the Lehman Brothers or IndyMac of this COVID-19.
Well, and then the hundreds of other banks that failed as well and were shut, like the Friday specials. They were shut down on Friday and reopened as another bank with all this. But isn't the fundamental issue here that the economy is strong, but it's been shut down? So these, yes, they're they're distressed, but nevertheless, the banks still have no option, right?
That's right. So the banks after 2008, 2009, under the Volcker rules and under the stress test rules, something called the Texas ratio, have to have a certain number of assets and cash on hand at all times. And if they don't meet this magic equation, they get put onto different levels of distress, to the point where if they get to a certain tipping point, the government will shut them down. And you can actually Google Texas ratio and see exactly where different banks.
Every bank is. And now, and so is that ratio has, I'm not sure which direction it goes, but it's today banks are much better capitalized than they were in the pre-2008 era to be able to carry this.
That's right.
Further before they run into federal issues.
There's a couple of reasons why. One is that they're actually better at managing cash reserves and asset reserves. But the other reason is that because they move quickly through bad assets, they no longer hold bad assets as long as they used to. And so going back to what we were saying earlier, they're mandated to either get them off their books, refinance them, or the one thing that I think is a great opportunity if you're sitting on dry powder, like I mentioned earlier, is to buy the paper.
Yeah, the notes. I was just going to ask you that.
That's right. Is to sell those notes and sell them to people that can maybe pay 60, 70, 80 cents on the dollar or maybe less, and they go through, and they're the ones that go and foreclose or put a
So
receiver.
that is exactly what happened during the last downturn. As you know, that's how you and I met. I transacted on over $1 billion of those notes.
That's right. I remember.
But the issue now is the banks are better off because they get them off the books quickly or more quickly. Okay, I get that.
Right.
But this is a tsunami, right? This isn't just ones and twosies.
No,
this is every single loan potentially on a bank's books could be headed this way, or a lot of them, right?
A lot of them. I think that there'll be a priority list at some point that will come out, either mandated by the government or created by the banks themselves, where optics for banks do matter. So Wells Fargo is still reeling from the silly opening up multiple accounts scandal that they had a couple of years ago. But otherwise, though, Wells Fargo is a very sound, very well-run bank, other than this consumer nightmare that they ended up in, that they're dealing with the optics now. So banks learn their lesson, and they're not going to want to foreclose on small families. They're going to probably prioritize the least optically bad property to foreclose on, whether industrialized warehousing, commercial space, those types of things. But eventually they'll be forced to work their way down all the way to the homeowner
that's right. But but there's a difference though. I think now is that the only thing I recall that was optically very bad was foreclosing on families and kicking them out.
Family homes, yep.
Yes, but any kind of commercial real estate was they had to do it, right? And that's what I worked through, intensively last time. But so are you already hearing from banks that we've talked about receivership, and we should talk about restructuring and turnarounds as well. Let's talk about that. But before we do, let's stay with notes as our fourth subject, actually, because it's very interesting. Are they already gearing up to start selling notes at discounts?
Right now, I think that's premature. I don't think they're at that phase yet, and I only think they're not at that phase and not thinking that far ahead just yet, because we're very early in this crisis. But I also think it's because a lot of the people that had experience like you or me in the last downturn have been working on other stuff, and we're going to have to clear the cobwebs and get back to what were the efficiencies that worked 10 years ago, and how do we institute those at the banks. I think that's a big part of it. We're looking at the first wave of defaults now that April 1st has passed. By May 1st, you're going to start seeing lists of properties that are going to be targets
default.
For the banks for default.
Yeah, but they're these are non-curable. Everything's curable. As I recall, it was 90 days. It was defined as being no matter what a borrower did.
That's right.
It was a bad asset. Is that the same? Is that still the same?
Those rules have not changed. Those rules remain in effect. It may be that at some point they get revisited, or that there's such a flood that it's just impossible to maintain. I've seen instances of that happen as well. But I think that there's going to be a lot of pressure on banks to maintain their foundational strength. And I think that they're going to have no choice but to start working through those assets. I haven't seen any grumblings about selling of notes or selling of tapes or anything just quite yet, other than what they've done in the normal course up until before this crisis.
Yeah.
But the next step after 90 days is going to be starting to sell that paper. The people that are calling me now are special servicers that are outside servicers not affiliated with the banks themselves, that are servicing notes for those banks, or worse, servicing them for the benefit of securitized bondholders that have bought them on the securities on the open market. And then you have former distressed asset managers that in essence want to come out of retirement to go help the banks work through what they see as the coming wave. And then finally, I have some real estate owners that are calling me and that have been clients for years that are saying, I've got this situation, what do we do now? And so you have a real concern across every aspect of commercial real estate at this point.
Richard, reasonably thinking about it, the 90 days was a drop dead period, as I recall. Banks, just no matter what a borrower did to cure a loan. It was uncurable after 90 days. It was a bad asset on the bank's books, and it had to be taken off one way or another. Right?
That's right.
There was nothing a borrower could do. It was done. 90 days. So if the first wave of defaults on mortgage payments was April 1, that puts us at May, April is the first, right? So those are now what, 30 days, May and June. So it's June 1st that is really, if there's going to be a big wave of defaulted, non-curable defaulted loans, that's the date that we should keep an eye on, is it, you think?
I think so, with one caveat, which is if we're forced to social distance and stay at home through June, you're not going to have the pump is not going to be primed. And so we're going to have to wait until people actually get back to their offices, I think, to get this started, because it's very difficult from your personal home dining room to call your lawyer and say, I need you to sue on this $100 million loan. But if we're stuck indoors through the summer, we'll figure out a way to do it.
Yes, right.
Mm-hmm.
Actually, it's interesting you say that. I mean, I just actually beg to differ. I think that there's no reason why you can't do it from your dining room.
Sure.
It's just fine. You don't have to meet people, but that's a whole different discussion. Let's move on.
As a lawyer, the biggest concern I have is access to the courts right now, because to do a receivership, you specifically need to go to court. And because the courts are either closed or they're only doing emergency hearings, I think the courts are going to have a knock-on effect, which is going to be that under the Constitution, as in a criminal proceeding, you're entitled to a speedy trial.
Okay.
And right now, if we're not getting to those speedy trials, the courts are going to be overwhelmed with the criminal docket, and they may just push off the civil docket for a while until they get through all those criminal proceedings. So we may be in kind of civil court limbo for a while, where we've got motions to appoint receivers just waiting, sitting. And if I'm a lender in that situation, you know what I do? I sell the paper. I sell that paper and
let somebody else deal with it. So it's a different situation. Last time, we were selling notes to buyers who were then taking over on foreclosures. Mm-hmm. But this time they're going to be facing a different environment, potentially an environment where there is more forgiveness, ultimately, that the federal government dishes out, do you think, because the circumstances are different?
Maybe. I also think that if this really is just hitting pause on the economy rather than an actual recession, mm-hmm. You may have where people buy this paper, and rather than foreclose and take over those assets, it's not loan to own, it's loan to renegotiate. It may be that you do some sort of extension or modification or whatever. One thing that I have been working on from my dining room is loan extensions and loan modifications. But you got to remember, these are loan modifications and extensions that were negotiated in early 2020 before this crisis hit. So I don't know if that will continue to be the trend, or if we're just going to see a completely different trajectory now that everyone is on pause with this.
Yeah, because there was this expression that was floated last time, the idea of extend and
pretend. Mm-hmm.
Yeah, but this time we're not really pretending, are we?
No.
If there's any extensions, it's extend because everybody believes that the economy, one has to believe the economy will come back, right?
As you and I know, now that we're in our third, fourth, or fifth downturn, I was trying to count how many downturns I've been through. I started with the OPEC crisis in the late 70s, early 80s, the savings and loan crash in the early 90s,
right?
The dot-com bust, the Great Recession. By the way, if you notice, they all happened pretty much at the turn of a decade. I was kind of looking at it's really at the end of every decade where you start seeing
so according to one of my podcast guests, Philip Anderson, he's a historical research. He figures it's every 16 years, 12 good years, and then 4 bad years. I think that's what I'm getting 12.6. Like since 1800, it's always been the same.
I tend to agree with him. There's like a real rhythm to wait.
Yeah, and he actually thinks this is a mid-cycle downturn. So let's get to a couple of other questions. So let's talk about, because actually talking about the banks, because the banking system is really what keeps the economy going, right?
That's right.
Liquidity in the market. And this is where
It's the grease in the engine, right?
yes, exactly. This is the engine that keeps the economy going, is the way that the banks function.
That's right.
And having been through it as much as we have, you and I, particularly last time, it's interesting to see what's happening this time. Right. So there are a couple of other things that you're dealing with. You mentioned two other things specifically, and these do apply directly to banks and to borrowers. One is restructuring, and one is a turnaround. So tell me something about restructuring in this context, and then we'll talk about turnarounds.
So restructuring, I always encourage banks before they go for the extreme measure of receivership or foreclosure to talk to their borrower. It is a very easy thing to do. You get a pre-negotiation letter in place. You may even get some sort of releases and waivers as part of that pre-negotiation letter. And you can work with, there are a lot of professionals out there, whether they be lawyers or accountants or other turnaround specialists or restructuring specialists. And you can talk to your borrower, see what their cash flow is, see what their P&L looks like, see what their balance sheet looks like, see what their projected revenue is. And you can sometimes right size a loan or right size a loan payment or modify that loan for the short term, for the long term, etc. So from a bank's perspective, there are more options out there than just foreclosing and receivership. The real problem I found in the Great Recession was those 90 days that we talked about earlier. Is it wasn't enough time to negotiate that right size of a loan. But now that we're kind of like on pause, I actually think now is a good time for banks to talk to their borrowers and restructure those loans or restructure those obligations.
Richard, they're allowed to do that? They are allowed to do that? They're
allowed to do that. They if they get a pre-negotiation letter in place, they're actually encouraged to do that in some instances. So they could say in theory, they could say we're going to pause loan payments for 3 months and add it to the principal, for example. Right. Exactly. I just did a deal like that last week. I spent, in essence, I spent 24 hours without sleep rewriting a loan and right-sizing it for a borrower on behalf of a special servicer. So there are ways to do this, and there are ways to make sense of it. The other thing, though, that borrower has to do, they have to make a commitment not just to renegotiate with the bank, but to renegotiate with all their creditors. And in those instances, there are turnaround specialists, chief restructuring officers, et cetera, that are very well trained in how to deal with those situations. And they have, they usually have a carrot and a stick, or they speak softly and carry a big stick, to quote Teddy Roosevelt. And they're able usually to create a cash flow, maximize cash flow, so that the secured lenders in those circumstances can get their due based on whatever they renegotiated. A turnaround is a little bit different. Turnaround, dovetails into actual insolvency, and you have a lot of different ways that you can skin that cat. You can do a turnaround by renegotiating your obligations, getting them to be lower payments. But a lot of times that is ineffective for some businesses, or there's a knock-on effect or a domino effect where if you cut off your vendor, then your vendor doesn't have enough cash flow to provide the goods and services that you need from them to keep your business going. So there can be these consequences that are unintended or unpredictable. So in a turnaround situation, you try to take all those things into consideration, and you have multiple tools to do that, some legal, some practical. The practical is like going out and negotiating with folks and figuring out where those sensitivities are. But then you have things like insolvency, like a Chapter 11, where you actually go and you restructure debt with a court officer or the U.S. Trustee's office overseeing that restructuring, and you put together a plan that the creditors have to approve and everything else. I'm not a big fan of bankruptcies because I always think they take too long and cost way too much, but it is it is an option out there for businesses that need to absolutely restructure from top to bottom. The other options are an assignment for benefit of creditors, which I actually think is a fantastic tool, where you actually take the assets of the company and put them in the hands of a trustee, and that trustee can negotiate the value of the assets versus the obligations out there. And that's an insolvency tool that works really, really well. You also have the insolvency tool of a corporate dissolution. If you look at the California Corporations Code or the Delaware Corporations Code, and most operating agreements, they have an orderly dissolution process already set up in the law or in their documentation, or both. And so you have these avenues that you can use. And usually, if you are able to get all the significant creditors in a room, in a proverbial room, you have these tools available to you to say, look, in this situation, in a Chapter 11, you're going to get 15 cents on the dollar. In an ABC, you're going to get 17 cents on the dollar. In a corporate dissolution, you're going to get 8 cents on the dollar. Here, we're offering you 20 cents on the dollar. So you're going to end up doing way better dealing with our proposed restructuring than you will in a bankruptcy or an ABC or a dissolution. So pick your poison, because these are the options that we have available.
This is a discussion you would have in a turnaround with creditors, but not necessarily with banks, right?
Not necessarily with banks, although it depends on if the bank's secured or not secured, because banks have secured lines and unsecured lines. A secured lender always holds the most leverage,
right?
But that leverage also means that they may have to take over that asset by credit bidding at a foreclosure, and they may not want to. And then that takes us full circle back to the beginning of the conversation, which is if they don't want to do that, then maybe a receiver is their best option in that regard.
Right. Credit bidding, just for those who don't know, means that at a foreclosure auction, they actually have to bid. Well, they don't have to, but it makes sense to bid the full amount of the indebtedness.
That's right. And we actually advise banks to start lower than the full indebtedness and bid up, because in a lot of instances you have personal guarantees, and the personal guarantee is offset by the amount that the bank actually pays for the asset, because that becomes the fair market value of that asset. And it's not an exact science, but that's typically how that math would work out. So if you're owed $1 million, you credit bid $500,000, you still have $500,000 that you can go after guarantors for in that regard. So,
woof. It gets ugly. The world is this serious flashback. I think the note I put on the invitation today was deja vu all over again, I think, or something I wanted to say. But
that's right. And I'll tell you, this never went away, but the frequency died down. Right. So there's always bad loans to work through. There's always receiverships to work on. They're just less frequent, and there's after 2008, 2009, where we were drinking from a literal fire hose. I mean, we were being sprayed with bad debt all over the place. I had everything from incomplete tract homes to high-rise buildings in downtown LA to high-rise buildings in Orange County, ski resorts in Idaho. I mean, it was all different types of asset classes, and most of them that I dealt with, by the time they get to me, I jokingly say they're really in an oh shit situation. So that we were putting them into receivership, or we were representing receivers that had taken over those assets. I think that each downturn is always a little bit different. This one will be different than the last one, but I think this one actually is going to be a little bit more efficient, because banks have no choice but to work through these bad assets quickly.
Okay, so let's exactly talk about that, because you were also talking about dry powder, advising clients to have dry powder. That dovetails into the idea that banks are going to work through them quicker, which I wonder about. I get it that they will work through them quicker, but the speed and of the volume is different than last time. Last time it was gradual relative to what we're doing now, right? It was just kind of slowly built and got worse and worse and worse. This time it's an overnight switch that has been thrown. So will they really have the capacity to work through them? And tell me about dry powder and why you think it's worth clients getting ready.
So looking back 10 years ago, you had situations where you had Class A type properties, Class B type properties, Class C type properties, and you mentioned it was gradual as to how things got worked out. And in essence, they did it in reverse order. The Class C properties were the ones that went down first, and the Class A properties, the downtown high rises and the LA suburban developments and those types of things, there was a lot more effort to try to keep those afloat. I think in this situation, I think it's actually going to be in the reverse. You're going to have to work out the Class A properties first. And so if you're going to prioritize, you're going to want to prioritize, to use the old MBA adage, the low-hanging fruit in that regard. But remember, you've got very limited time to do so. So banks, if they remember their lessons from 10 years ago, are much better off taking that paper and selling it to someone that has the time and the dry powder to be able to afford that long tail of what would be to renegotiate, recategorize, right size, or foreclose or put into receivership, right?
If they can afford to take the loss, though, right?
That's right.
You're suggesting a loss on the paper.
That's right. And for the Class A properties, those losses will be much less than their Class C, Class D. I worry more about what happens as you get further along in the cycle and banks have to start dealing with properties that are in suburban Fresno versus suburban LA, where as lovely as Fresno is, that property is not as easy to sell in an economic downturn than something that's outside of Los Angeles.
Well, that's no different than last time.
That's the same as last time. That's right.
Yeah.
That's right. So you have a lot of considerations. I actually, as someone who personally invests in real estate and looks at the real estate market, not just as from my legal glasses, but through a different lens as well. I think that there will be opportunities for buying assets in two ways. One from the banks, like we talked about, but also if you're a property owner and you are in distress, I think there's enough people sitting on cash now that if you list your property for sale and it's in one of those attractive areas, a Class A or Class B zone, you're going to have a much easier time selling that real estate, particularly now that there's going to be a drop in price and everything else. And a lot of folks have been holding on to property for a long time. So even if they sell at a value that was less than what the property was last year, it still may be for a profit for them long term.
Yeah, and not only that, but cover their debt.
That's right.
And maybe put something in their pocket instead of going bankrupt.
That's right. Right. So they'll line their pockets with a tiny bit of cash. They'll get out, cover their debts, and somebody will be very happy because in 5 years that property will go back to what it was worth.
Exactly. That's interesting.
That's what I think is going to happen. And look, we talked about a month and a half ago. We could never have predicted the situation that we were in 6 weeks later.
Isn't that crazy?
So I always try to look into my crystal ball with a lot of caveats and warnings.
All right, so I'll tell you what then. Let's sign off today with one final question, and then I've got another one actually for you. Might find interesting offline. I want to run by you because we should explore some ideas. But right, so crystal ball. Please peer into it and tell me what you think we will be talking about in 4 weeks' time when we do our next podcast.
In 4 weeks, we're going to see statistics on loans that have not been paid. And we're going to get a much clearer picture as to what type of assets are going to go first in the downturn. And I think that that's an opportunity to be had for a lot of investors. I also think it's a good way for banks to shake out those loans that they probably should be revisiting anyway at this point. The problem is that in 4 weeks, we'll be talking about that. But in 12 weeks, we're going to be talking about everything, I think.
Yeah. Richard. Professor Richard Ormond, Esquire. Always a pleasure to talk to you. Thanks so much.
Thank you. I'm excited to talk to you today.
Yeah, the feeling's mutual. And we'll do another one. Let's stay at the sharp edge of what's going on, you and I, and get this out.
Perfect. I'll keep reading the papers and reading The Economist and everything else and to keep sharp for us.
That was Richard Ormond, attorney at Buchalter, discussing some of the key terms you need to know so you can identify ways of bringing capital to sponsors who need it today while making money for yourself in the process, at the same time helping aid the recovery effort. Very important episode today. Be sure to go to the podcast page for today's episode at gowercrowd.com, and importantly, to get access to opportunities as we start to see them, sign up for my newsletter. Actually, you can sign up for anything and you'll be automatically put on the newsletter list where I'll be making all the announcements. There's a lot there at gowercrowd.com for you to sign up for, from training on how to upgrade your home office, a guide for crisis communications, There's a huge discount on our flagship investor acquisition system online master course, over 80%. And be sure to check out our articles under the Advances tab for more information as well. All right, all there at gowercrowd.com. Sign up for anything, right? And you'll be on our list for early notification of opportunities. All right, that's it. Thanks for listening. And thank you, Richard Ormond, attorney at Buchalter, for your time with me today. As always, pleasure to talk to you. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.